Okay, let's just state the obvious. Bitcoin is on an absolute tear right now. And if you're an investor, that feeling is probably pretty incredible. But with these huge gains comes a really important question. When the party gets this loud, how do you make sure you actually protect what you've earned? Well, that's exactly what we're going to break down today. So let's get real for a second. Picture this. The price is screaming towards $150,000. The euphoria is absolutely everywhere. In that exact moment, do you have a rock-solid plan, or are you just kind of riding the wave, hoping for the best? Because this is the point where having a good strategy isn't just a nice-to-have, it is absolutely essential. So to get you ready, here's our game plan. First, we're going to talk about a huge mindset shift, from offense to defense. Then we'll dive into two really powerful strategies, one called core satellite and another called cycle rotation. We're also going to learn how to think like an institution, and finally, we'll cover how to survive the most dangerous part of any bull run, the euphoria. All right, first things first. When you're this deep into a bull market, the game you're playing fundamentally changes. Your main goal is no longer about playing offense, trying to squeeze out every last drop of profit. Nope. It's about switching to a really strong defense to protect what you've made. Think of it like this, right? The goal that got you here was all about maximizing your upside. But the goal that's going to get you through this entire cycle, that's about protecting those hard-won gains. It's a massive mental shift from just accumulating more to preserving what you have. What this is all about is protecting asymmetric gains. Now, that's just a fancy way of saying returns that are so massive, they can literally transform your entire financial picture. The mission now is to make sure those potentially life-changing gains don't just disappear in the next big wave of volatility. Okay, so let's get into our first actionable strategy. It's called the core satellite approach. And honestly, this is perfect for anyone who still truly believes in Bitcoin's long-term future, but wants to manage the crazy short-term risk like a pro. So how does it work? Well, it's a super disciplined three-step process. First, you decide on a target allocation for Bitcoin in your portfolio. Maybe it's 5%, maybe it's 15%. That's totally up to you and your risk tolerance. Then, and this is the hard part, as Bitcoin rallies and grows past that target, you systematically trim the excess. So let's say your target was 10% and it balloons to 25%, you sell that extra 15%. And the final step is to reallocate that capital. And where does that money go? You move it into less volatile assets to basically lock in its value. Things like US Treasuries, which are seen as a safe haven when things get chaotic, or high-quality stocks, or other assets that give you some global diversification. You're essentially taking your winning chips off the table and putting them in a safe. Now, here's a super important point. Using a core satellite strategy does not mean you've stopped believing in the Bitcoin story. Not at all. It just means you are being smart and proactively managing what's called concentration risk, which is just what smart investors do when one single asset starts to completely dominate their portfolio. All right, on to our second strategy. This one's called cycle rotation, and it's a bit more active, a bit more tactical. The whole idea is built on this observation that late cycle strength in Bitcoin is often a big signal that all that speculative energy is about to spill over into the rest of the market. This approach is kind of like a four-step dance. First, you spot that late cycle strength in Bitcoin. Then, you rotate some of that capital into other high-growth areas to ride that big wave of market liquidity. All the money sloshing around looking for a home. But, and this part is key, you have to keep a close eye out for signs that this liquidity is peaking or starting to dry up. When you see those signs, you make the final move. You shift into defensive assets to protect your capital before a potential downturn. So in that second step, where's the money flowing? Well, when liquidity is really strong, capital often rotates into other crypto assets, high-growth stocks, and even places like emerging markets. These are basically all the areas that tend to do really well when the speculative appetite is high. And that final protective move is so crucial. Once you see signs of liquidity drying up, like maybe you're watching the US dollar index get stronger or hearing the Federal Reserve start to sound a little more aggressive, it's time to shift. You rotate into things like defensive stocks, dividend pairs, or even just cash, all to cut your risk before a major drop. Now, both of these strategies we've talked about, they really rely on one core principle, which is our third big idea. Think like an institution. This means taking your emotions, putting them in a box, and replacing them with a systematic, disciplined process that is driven by volatility, not by your feelings. Here's the absolute night and day difference. The typical retail approach is to react emotionally, buying when you're euphoric and selling when you're panicking. The institutional approach is the complete opposite. They don't react to emotion. They rebalance systematically, based on volatility and preset rules. Look, for a big institution, Bitcoin isn't the entire portfolio. It's not even close. It's often just this small, like 2 to 5% sleeve inside a very traditional stock and bond framework. They treat it like a high volatility macro asset, not an all or nothing bet. So, what happens when the price of Bitcoin goes to the moon and that little 5% sleeve suddenly balloons to 15% of their portfolio? What do? They don't go all in. Their one and only goal is to trim it right back down to its original policy weight. It's this discipline that lets them capture gains without getting totally wiped out by volatility. And this brings us to our final and, I think, maybe the most important section of all, how to survive the euphoria. This is all about recognizing the tangible, real-world market signals that are basically screaming maximum risk ahead. Okay, here are 4 huge warning signs to watch for. First, a price chart that goes almost vertical, just straight up. Second, a massive spike in leverage being used by retail traders. Third, the mainstream media is talking about it nonstop. And finally, and this one's critical, you see a divergence where the price keeps climbing, even though the underlying liquidity in the market is starting to fade. So what happens when all these signals start flashing bright red? Well, historically, periods of extreme optimism like this are followed by some major corrections. We are talking about drawdowns of 30 to 50%. And that's not a guess, that's just a historical pattern. But here's a really crucial piece of context. A sharp, painful correction doesn't automatically mean the bull cycle is over. A lot of the time, it just means that volatility, which is a totally natural part of this asset, is expanding. Surviving this period is just part of the game. As we start to wrap this up, let's be crystal clear about the goal here. The objective is not to get lucky and sell at the absolute perfect tippy top. I promise you, trying to do that is a fool's errand, and it's only going to lead to a ton of stress and probably some bad decisions. Instead, the true objective is this: to survive the full cycle. That's it. Strong investors, they accumulate when everyone is pessimistic, and they rebalance methodically when everyone is euphoric. They play the long game, because in the end, survival is the ultimate victory. And so I'll leave you with this one last thought. Having a plan for the euphoria, that's half the battle. But what's your plan for the pessimism that will inevitably follow? Because that is where the foundation for the next cycle's gains is truly built.